Hello, my name's Chris Pedersen and this is Stock Watch for Finance News Network on Wednesday the 26th of July 2023. Any advice provided is general advice and may not be suitable for you. Always consult your advisor before making any investments. All questions from viewers should be sent to stockwatch@fnn.com.au. My first slide is our population growth rate in Australia. As you can see, it is very strong compared to other countries. This is a reason why our economy tends to grow better than most other major emerging and mature economies. Job openings to unemployment rate ratio. As you can see, it is very strong. Here, this slide is very important. What it shows is that we have massive increase in labor costs while declining productivity. This is something we have to address. Is this because more people are working from home? I don't know. Recent studies show that working from home people tend to be more productive because they put in longer hours. This is the RBA balance sheet slide. The orange is very important. TFF stands for Term Funding Facility. This is the RBA lending banks money. Well, this facility is over and this is going to be reducing over the next couple of years, which means banks will have a greater demand for term deposits and borrowings from overseas. This is interesting because Israel has been in the news a lot lately. I saw this pie chart and I wanted to share it with you. What you see is Arabs and secular Jews are more than 50% of their population. Secular means non-religious. Thus, some of the radical movements we see in the judiciary may not truly represent the will of the majority of the population. Today I'm going to cover supermarket sector. The companies involved is Woolies, Coles, Metcash, and I'm also throwing in Endeavor Drinks. Supermarkets are consumer staples. Recent consensus earnings upgrades are for Woolies, Coles, and Metcash. They benefit from population growth as that previous chart shows. My view is slow and steady wins the race. Supermarkets dry goods market share chart. What is important here is that this chart is very similar for not just dry goods, but also for fresh fruit and veggies. You see Woolies dominating, followed by Coles, and then you also see Aldi getting up there. But still, the majority of the market is dominated by Woolworths and Coles. Woolworths is currently trading around $38.83. This is a 3-year chart. What you see is it's in a sideways trading pattern, up and down, up and down. It's good for traders, but not necessarily productive for long-term investors. Looking at the fundamentals, we see that the volatility beta is only 0.24. Market cap for Woolworths is $47 billion. 12-month price target on an average of a lot of brokers is around $42. A lot of brokers are rating it as a buy. The revenue growth rate for 2023 to 2025 is estimated at 4.3% per annum. The earnings per share growth during this period is 9.0% per annum. This high growth rate with the revenue growth as it is cannot sustain itself. The dividend growth during this period is 8.5% per annum. Now looking at the ratios. The PE ratio on 2024 earnings per share estimate of $1.57.5 is 24.6 times. This is a little bit high for non-mining, non-financial stocks. The yield on 2024 dividend estimate of $1.19 is only 3.1%. Usually companies that have slower growth become yield stocks. In order to keep the price up, they have a higher dividend payout. The free cash flow is estimated at 4%, and the payout ratio for Woolies is 75%. Brokers tend to be bullish on Woolworths. I am more circumspect. For a slower growth income stock, its yield is just okay. Revenue growth is poor. I would be, at most, a half weight. Coles Group. It's trading at around $18.09. Looking at the chart, you see it is also trading sideways like Woolworths. Looking at the fundamentals, 12-month price targets by various brokers picked at random. We have Citibank, $20.20. They rated a buy. UBS is $18.50. They're neutral. Macquarie rates it with a 12-month price target of $20, and they say outperform. Goldman Sachs is on the low side at $15.80 target price, so obviously they're a sell. And Jardine is at $17.50. They're neutral. The beta on Coles is even less than Woolworths at 21.21. Market cap is $24 billion, so it's about half the size of Woolworths. 12-month price target I have is around $18.50. The revenue growth rate from 2023 to 2025 is estimated around 3.8% per annum, whereas the earnings growth in this period is 3.9% per annum, and the dividend growth is a little bit slower at 3.5% per annum. Looking at the ratios, we have the PE on 2024 earnings per share estimate of 85 cents at 21 times. This is lower than Woolworths. The yield on the 2024 dividend estimate of 64 cents is 3.5%. So the yield here is better than Woolworths. The free cash flow is poor at only 3%, and the payout ratio is 77%. Coles has higher yield, lower PE, and thus it seems more attractive to me. Coles has not performed as well as expected though. I've liked Coles for a few years, and if I'm not trading it, sell at the highs, buy at the bottoms, which is very hard to do. It's defensive. I only give it a half weight also. The third supermarket is Metcash Limited. Code is MTS on the ASX, and it's trading around $3.64. Now looking at this chart, what you see is a fairly strong rally, but now it's fading. Let's see if it can recover. These are UBS estimates, by the way. The beta is a negative 0.03, which means it doesn't correlate to the market as a whole. The market capitalization is only $3.5 billion. 12-month price target, I have it around $4.08. Many brokers rate it around neutral. I think that's a fair, reasonable rating. The revenue growth from 2023 to 2025 is estimated only 0.5% per annum. EPS growth is flat, dividend growth flat. The PE on next year's earnings per share estimate of 29.8 cents is only 12.2 times. The yield on next year's dividend estimate of 21 cents is 5.7%. Free cash flow is greater than 5%, and they have a payout ratio that's less than the others at 70%. If Metcash can get some revenue growth rate here, the price can soar. It has a cheap PE, it has a high yield, it is a decent income stock. However, I would wait before buying it to see if they can turn around this lackluster revenue growth. Endeavor Group, they're the company that owns Dan Murphy. The code on the ASX is EDV, and it's trading around $5.96. The beta for this stock is only 0.14, and the market cap is $11 billion. 12-month price targets. UBS has $6.75. Morgan Stanley is at only $5.80. So again, you see massive divergence in opinion for this company going forward. The revenue growth from 2023 to 2025 is estimated at 3.5% per annum. The earnings per share growth in this period is 6% per annum, and the dividend growth is 4% per annum. The PE on next year's earnings estimate of 31 cents is 19 times. The yield on next year's dividend of 22.5 cents is 3.8%. Free cash flow is around 3.75%, with a payout ratio of around 72.5%. 84% of the company's income and profits comes from drinks. 16% is from hotels. Dan Murphy's specials have declined, I notice. I think management is struggling with the sales growth versus profit margin debate. Right now, I would avoid Dan Murphy, Endeavor Group, until they start improving and increase revenue growth. As always, if you want to learn more about anything I covered today, send an email request to stockwatch at fnn.com.au, and direct it to me, Chris Pedersen. Thank you and have a wonderful, profitable week.